Hello, it's Tom from Hudson Valley Tax Experts. Happy summer, almost. Thanks for taking a moment to learn about the changes that are upcoming for the child tax credit. If you're a parent, you're going to want to know how this is going to impact you for the next couple months and your 2021 return. This is me. You can read about me at your leisure on our website. Also, my colleague Amy. If you have any tax issues hanging over your head, whether it's unfiled tax returns, tax debt, liens, anything, audits, feel free to use our website, get in touch with us. We'll be happy to talk to you to see what we can do to help you out. Today we're talking about what's changed with the child tax credit as part of the American Rescue Plan, which was passed in March of 2021 and which can potentially affect 80% of taxpayers who have children under 18. So if that's you, you're in the right place. The changes that are coming and at a broad level are that some people are going to find the child tax credit more valuable. It's going to be worth more money to them. And some taxpayers who didn't previously qualify for all or perhaps any of the credit will now be able to get a benefit from that. And this kind of brand new thing, this monthly income stream starting in July that we haven't really had previously. So we'll talk about all this in detail. The potential change is in value is that where the credit used to be worth a maximum of $2,000 per child, it's now worth up to $3,000 or $3,600 depending upon your overall qualifications. The credit is now fully what we call refundable, which means that if you don't need the entire amount of the credit to offset the tax on your return, the portion that isn't used can come back to you as part of your refund. It used to be potentially some of it would come back, but not all of it. Now everyone would get all of it back, so you get the full benefit of the credit. It's gotten a little more complicated in that there's two income levels where the benefits are potentially reduced. That's called a phase out. So we used to have one level before, now we have two. We'll look at those in detail. And we've got this monthly income with a reconciliation on the tax return that we didn't really have before. There's going to be some potential pitfalls, of course. Any changes have a good side and a bad side typically. So some people are going to see possibly smaller 2021 tax returns because of the benefit being spread out over the year. Some people might, in fact, end up having to write a larger check at the end of the year because they're getting the tax benefit in advance. Some people may have to repay some of their amount that they received if they don't qualify for the same amount when they actually file their 2020 return. Some scenarios where that might be the case, if the income has increased from 2020 to 2021, if the filing status has changed from married to unmarried or vice versa, for example, or if you've got parents who are not filing jointly and are alternating who claims the children from year to year, that could be a problem as well. So I can't give you every possible scenario in a presentation that anyone's going to want to sit through. So in order to personalize this or to figure out the impact to you personally, you're going to need some key data from your 2020 tax return, or if you haven't filed 2020 yet, it'll be from your 2019 return. And it's really three pieces of information. The first is your filing status, which you might know off the top of your head. For our purposes, we're going to use three categories: married filing joint, which is a married couple filing a single return; head of household, which is a single parent who qualifies for the status and has an eligible child; and everyone else. So obviously everyone has to have a child, but head of household has some additional criteria to be using that status. So look at your tax return to figure out which filing status you used on your last return. Also look at line 11 to get your adjusted gross income. This is kind of a magic number in tax. It determines your eligibility for many different tax benefits, and it's the starting point for figuring out your taxable income and thus your tax. So we need to know what that number is. And then hopefully you don't need to look at your tax return for this, but we need to know how many children you have and what age they will be at the end of 2021. If they haven't yet had a birthday, remember to take that into account. We need their age on December 31st. And there's really two categories: the 0 to 5 bracket and the 6 to 17 bracket. On your tax return, on the front under your address are the lists of children that were on your 2020 tax return. And if the box in column 4 is checked for the child tax credit, those are the children that the IRS is going to be using when they estimate what your impact is going to be. So that's what the IRS knows about. Any changes to that, they won't know about yet, obviously. So in order to understand the impact of the changes, I need to take a moment to just refresh you on how the prior child tax credit worked. And we're calling it classic in quotes. That's not a term you're going to see on the IRS website. That's just my terminology to be able to distinguish between what we had and what we're going to have. And the child tax credit has been around for many years. In its current form, it's been around since 2018. And when a tax credit doesn't directly put money separately into your bank account and doesn't change year to year, it's easy to kind of gloss over and you don't really understand what is happening on the tax return. So just to refresh, it was a maximum of $2,000 per child, and that was a child under the age of 17. So 0 to 16 at the end of the year. And once your income, your AGI, passed a certain threshold, we started to have one of those phase outs where the credit got reduced. And for the classic child tax credit, those levels were $400,000 for married filing joint and $200,000 for head of household, as well as everyone else. So there's really only 2 income levels for the classic tax credit. You also had to have at least $2,500 of tax return income. I mean income that had to go on the tax return. So if you had, for example, workers' comp that isn't reportable on the tax return, that wouldn't count towards this. And if that was your only income, you didn't have $2,500 of other income, then you wouldn't have qualified for the classic child tax credit. So we'll look at example taxpayers. We're looking at married taxpayers here whose income is $125,000. If you are not married, then you would sub in something like $60,000 for the income here to get to the same type of scenario. They have 2 children, Judy and Elroy, with the ages 15 and 4, and that would have gotten them a $4,000 child tax credit, $2,000 for each. There's no phase out because their income is below the $400,000 threshold for filing jointly. And how that would look on their tax return, well, this wouldn't look like a tax return, but what the result would be on their tax return would be that $4,000 would reduce the tax directly. So assuming they had nothing else going on their return except the standard deduction and the 2 children, their 2020 tax would have been about $13,700, and the child tax credit would have knocked that down by $4,000. So if their withholding was at different levels here, for example, they would get a bottom line number that would be either the refund or what they owed. So if they had a lot of withholding, $15,000, they would get $53.76 as their refund. And if a similar couple, same income, who didn't have any children, would have gotten a refund of $13.76. So that $4,000 child tax credit is directly reducing their tax, and because they had so much withheld, it's increasing their refund by that amount. Someone with somewhat less withholding could still be getting a refund, but you'll notice that that refund, $2,300, is less than the child tax credit. So without the children, someone in that same situation would not be getting a refund, but would be owing $1,700. And then we have someone at the very end here who is taking full advantage of the child tax credit to offset their tax and get themselves right around zero. So they've got, in this case, $9,500 withheld, so they write a small check at the end of the year. None of these scenarios, are bad. It all depends on what the taxpayers want at the end of the year and what they want, in their monthly or weekly paychecks. But the overall impact, the overall setup you're going into 2021 is going to determine how this 2021 change is going to affect you. If our sample taxpayer's income was substantially lower than the $125,000 we said that the child tax credit could get eliminated or reduced. So if they were below the $2,500 threshold on the tax return, if the bulk of their income was not taxable, or if they just didn't have at least $2,500 of income, they wouldn't get any child tax credit. It would be zero. If they were slightly above the threshold, they'd get a little bit of the credit. So at $3,000, they'd get $75 of child tax credit. So a far cry from the full $4,000 potential benefit. On the other hand, if they were income was substantially higher, above the $400,000 threshold for filing jointly, or above the $200,000 threshold if they were not filing together, then the credit would start to get reduced. So at $410,000, as an example, their credit would be down to $3,500 instead of $4,000, and as the income goes up, it would eventually get reduced down to zero. Now, for 2021, and at this point it's only for 1 year, we have this expanded child tax credit. Again, that's my terminology to kind of distinguish between the two. And what's happening here is, first of all, there's no minimum income level, so people that wouldn't qualify for any benefit before are now going to get the full benefit regardless of their income on the tax return. The maximum has been increased to either $3,000 or $3,600 per child, depending upon the child's age. We'll show that in a moment. And this is essentially an additional $1,000 or $1,600, which is on top of the classic portion of the credit. This enhanced amount has a new phase-out range, separate from the old one, and will start to go away once your income passes the levels shown here. So $150,000 for joint, $125,500 for head of household, $75,000 for everyone else. Once the income passes those points, which I've reiterated at the top of the slide here, then the credit is going to get reduced by $50 for every $1,000 more of AGI that you have until it hits zero. But that's only reducing the expanded portion of the credit. The classic $2,000 portion would still be available up to the same thresholds that we had previously, $400,000 for a joint return, $200,000 for everyone else. And that would separately reduce until the credit, entire credit, both portions hit zero. The horizon when you reach zero depends upon the number of children and the age of the children. So I can't give you an exact number by filing status, how far out you would go before you lost the credit. You'd have to figure it out yourself. So, for example, we return to our George and Jane couple filing a joint return. Judy, being over the age of 5 at the end of the year, qualifies for the $1,000 enhanced portion. Elroy qualifies for the $1,600, and they each qualify for the $2,000 classic portion. So their total child tax credit, maximum child tax credit, is $6,600. How much they get is going to depend on their adjusted gross income. And we're looking at 2021 figures, what it matters. If their adjusted gross income was very little or even zero, they would still get the full amount, $6,600, where they didn't get it before. If their income is above the $150,000 enhanced phase-out threshold for married filing joint couples, then the credit starts getting reduced. So for example, at $160,000, rather than getting $6,600 in total, they get $6,100 in total. And if the income was higher enough that the entire enhanced portion went away, they would still get the $2,000 classic portion per child, so $4,000 maximum at $250,000 of income, and that wouldn't start going away until they hit the higher classic phase-out threshold, shown there in blue, $400,000 for joint, $200,000 for head of household, and everyone else. So that's all to your benefit. And nothing's getting removed that wouldn't have gotten removed before, and if your income is at or below the enhanced phase-out threshold, you're going to be getting more money. If your income is on the extremely low end, you're going to be getting more money than you would have qualified for in the past at all. What's the wrinkle that we have to deal with is these monthly advance payments that are going to start next month, July, and continuing through December. And essentially, the IRS is going to estimate your 2021 credit based on the information that it knows from your last filed return, 2020 or 2019. and they're going to give you payments using up part of your 2021 credit, which could potentially affect your tax refund. You might be looking at a smaller 2021 refund than you would have if you didn't have the monthly payments. You might go from getting a refund to actually owing the IRS money at the end of the year. And if you're not qualified because the changes are so significant that you get advanced money that you weren't fully qualified for on the 2020 return, you're going to have to pay some or all of it back. The monthly payment amount is going to be 1/12 of the estimated total credit. So we just looked at George and Jane, and their maximum was $6,600. 1/12 of that would be their monthly amount. The total credit, as we've discussed ad nauseum, is going to be based on your income, filing status, and your children's ages. It's going to get delivered to you either by direct deposit into your bank account or by check or possibly by debit card. And the IRS will have a portal on their website for you to make changes or opt out entirely if you so choose. Non-filers will be able to register if they want to get the monthly payments. So to figure out what your likely monthly payment is going to be, you're going to need those 3 pieces of information that I told you to look at from your 2020 or 2019 return: filing status, AGI, and number of children in each age range. I do want to mention that if you have other dependents on your return, either children over 17 or others, perhaps parents on your return that aren't children, then they would still be on your return, and whatever tax benefit you get from them would still exist. They wouldn't factor into the monthly advance payment amount. They're not part of this credit. So nothing's changed with them, but they're disregarded for this purpose. So to estimate how much you'd be getting, on the back of an envelope, basically take the classic portion, multiply it by $2,000 per child, and then if your income is below the phase-out range, add the estimated enhanced portion of either $1,600 or $1,000, depending on the child's age. Take that total for all your children and divide the total by 12 to get your estimated monthly payment. Now, if you're affected by the phase-outs or just don't want to do math, there's plenty of online calculators you can use which will estimate the number for you. Just search for 2021 Child Tax Credit Calculator. You can plug the numbers in. So a couple of examples are George and Jane couple with their $125,000 income and 2 children. Total credit estimated to be $6,600, which means they would get monthly payments of $550 starting in July. Another example, Jenny's filing as head of household with her 14-year-old son. Same income level. She is above the enhanced phase-out range. So back of the envelope, I'm just going to estimate the $2,000 classic portion of the credit, which would be $166 monthly. If you plugged her numbers into an online calculator, you should, I believe, find she would get $2,350 as her estimated total, because she's in the $1,000 additional is getting reduced but not down to zero, which would mean $196 a month would be her payment. So the monthly payments are prepayments of the credit that would be claimed on your tax return, so are going to affect your 2021 refund when you file your return. So here we have basically George and Jane, married filing joint couple, 2 kids, 15 and 4, and looking at their 2021 return being exactly the same as the numbers on their 2020 return, their income tax would be a little bit lower, $149 less, because of the change in the standard deduction. The child tax credit would be $2,600 more because they qualify for the enhanced portion in full and they have 2 children. They got $550 a month for 6 months, so between July and December they would have gotten $3,300 already. If the withholding was the same levels we looked at in the prior example, their refund would be somewhat reduced. It would be reduced by $551. They've gotten as a whole over the from July until whenever they filed the return, February, March, April, they would have gotten $2,749 more. That's the $2,600 additional enhanced child tax credit, and the $149 from the reduction in tax, but because they got the monthly prepayments, their refund is $550 less. Or in the very last category, when they were writing a small check, they're now writing a slightly bigger check for $1,100. So there's still overall a bigger benefit, but the end of year on the return number is going to be different. If they are above the enhanced phase out entirely, so here we're going to assume a similar situation, a similar couple, but the adjusted gross income is $210,000, so they are above the point where they're going to get any enhanced child tax credit. Their income tax from 2020 to 2021 will have gone down about $190 because of the change in the standard deduction, and because they're at a higher tax bracket, it's a little bit higher than the previous example. They still qualify for the same $4,000 child tax credit they would have in 2020 or 2019, but they got half of that, $333 a month, for the last 6 months of 2021. So their refund is going to be $2,000 less, even though their overall tax benefit is just $189. So the income tax has gone down by $189, but because the child tax credit is getting partially prepaid, there's no additional benefit to them from that because their income's too high. Their refund is going to be $2,000 less than it would have been otherwise. Or in the final example, instead of writing a check for $400, this person will be writing a check for $2,400. Someone who doesn't qualify for the credit at all, or at least not to the same level, is going to have an even more unpleasant surprise at the end of the year. Here we have a taxpayer who is filing separate from their spouse, and they have 2 children, and the taxpayers swap them. This taxpayer claims them in even numbered years, so they were on the 2020 return, and then the other spouse would claim them on 2021 odd numbered years. So their income tax is down slightly, but if they didn't take steps to turn off the prepayments based on the 2020 return, they would have gotten $3,300 from July through December, which is essentially a short-term, no-interest loan, but they have to pay it back when they file their tax return. So if they had $12,000 of withholding and hadn't taken the prepayment, they would have gotten a $2,500 refund, but if they took the prepayment, they're instead going to write a check back to the IRS for $788. At the other end of the scale, someone who would have been writing a big check without having the kids on the return, $3,400, would now instead be writing a check for $6,800, which would potentially turn a no-interest loan into a fairly high-interest loan if they have to now, if they can't afford to pay that all back with their tax return by April 15th. So I'm certainly not going to suggest that everyone opt out en masse. There are going to be many people who having the monthly income is going to be important, and as long as you are entitled to it and you know what the effect is going to be on your tax return, you should certainly take that. But in certain circumstances, you may want to opt out. You should assess, I would say, if your filing status has changed from 2020 to 2021. So if you've gone from married to filing separately, or divorced or separated, or if you've gone the other way, so you were not married in 2020 and are now married in 2021, that could be a factor. If your 2021 income is going to be higher than it was in 2020, particularly if you're around the first phase-out threshold, you're going to want to take a look closely, because if you don't qualify for the enhanced portion of the credit, you're more likely to be impacted adversely. And when you're doing this assessment, you need to remember that 2020 was a very odd year in many respects. For example, if you were collecting unemployment in 2020, you might have qualified for a portion of that not being included in your income. That wouldn't be the case in 2021. Just in general, some people worked less, some people worked more in 2020. The last year was quite odd for lots of people, so it's difficult to compare last year to this year without looking at it in detail. Definitely, if you have children on your 2020 return that will not be on your 2021 return, you're going to want to opt out because you won't qualify for the credit based on those kids. If you are dependent or rely on getting a refund of a certain size, the prepayments could affect that, and depending upon your situation, they might affect it significantly. So if that's important to you, you're going to want to take a look at that and possibly opt out. And in particular, if your 2020 refund was less than your child tax credit, then part of your child tax credit was basically paying your tax for you, and so you're more likely to be a smaller refund or paying more at the end of the year. We don't have specific details yet on how you're going to opt out or make changes. IRS.gov will have a portal where you'll be able to do this, and it's supposed to be available sometime in the next month. We don't have any specifics as to date. We are told that it will let you opt out entirely from getting monthly payments. So if you don't want to receive them and just want to get the benefit at the time you file your return, you can do that. And I want to stress that if you opt out of monthly payments, you're not giving up anything. You will get the full amount that you're entitled to as part of your 2021 return, and you wouldn't have any possibility of having to pay anything back or having an unpleasant surprise as to how much you are getting back or how much you owe. So there's no downside to opting out except not getting the money earlier. You can remove or potentially add eligible children if your household has added a new member, either new birth or adoption or for some other reason. You'll be able to factor that into your prepayments. You can adjust your estimated income either up or down to have that reflected in the monthly payment amounts. You can change where you want the payment to go, whether you want to specify a bank account because the IRS didn't have one, or if you change your bank account, change your mailing address, you should be able to do that. And you'll apparently be able to sign up if you don't normally file a return, so you can get the benefit of the prepayments without having to wait to 2021. So I hope that was helpful. Thank you for taking the time to listen, and visit our website for more. Have a great rest of your day, and thank you for listening.